The economy booms with low taxes, which results in greater tax revenue. In this episode, I'm going to address the question, raise taxes or raise the revenue that's being taxed? Get ready, I want to enlighten you. Hi, I'm Doug Andrew, and I've been helping people for more than 4.5 decades optimize their financial assets and minimize taxes. So I've studied a lot of ways that governments choose to raise tax revenue. But if you stay with me to the end of this episode, I have a very powerful free gift for you that could be a game changer for your brighter future. So let's talk about general tax principles here, because I can show you historically proven models when there has been questions, should we raise taxes or should we raise the revenue that's being taxed? So let's look at it like a business owner would look at things. When you're faced with having to raise some revenue, okay? Now the government, they need to raise taxes, and I'm a red-blooded American. I think we should all pay our fair share of tax. But generally speaking, there's two basic political philosophies. And this is not a political agenda here, but basically one believes that we ought to have more and more government programs and so forth. And the best way to raise tax revenue is by simply raising taxes. And usually the more you make, the more they take. So tax the rich, right? Now, I have found in my career that many wealthy people voluntarily contribute to society as much as 30 and 40% of their income. They're very generous. And they would prefer to do that to the causes they support rather than being forced to have their tax dollars go to things that they don't support. And I'll share with you an actual example of how I've asked audiences that have been mixed between two political parties. And people always, if they have the choice, would like to direct the tax revenue to the causes that are in alignment with their values. That makes sense, right? Now, the other political philosophy is, well, let's just get by with the least amount of government. Let people take ownership for their own future, for their own health care and so forth. And any government revenue that we need, let's raise the revenue that's being taxed. And so I'll give you some examples of this from different administrations, because you can study any tax laws that have been passed for the last 30, 40, 50 years, and you can pretty much tell who was in control of Congress or the executive branch or both, okay? So let's go back to the 1980s. I remember in 1980 we had a recession in America. It was called an energy crisis. And in Houston, Texas, for example, where, of course, they had a lot of oil fields and so forth, 16,000 homeowners lost their homes in foreclosure in 1980. And we had a recession hit. In fact, I had 3 things happen to me in 1980 that I never dreamed would happen simultaneously. And I found myself without an income for about 9 months. So I've been there. Now, President Reagan came into office in 1980, and he served 2 terms. And he believed that you should only tax people up to a certain percent, because he studied history all the way back to biblical times. And he realized that if you tax people more than about 25 to 28% at a federal level, because most states in America right now, 41 out of 50 states, has a state income tax. And so if you add the state tax on top of the federal, if you tax people more than 1/3, it actually hurts you instead of helps you. People resent it. They say, what's the use? And they stop hiring, they stop expanding, they stop spending money, and they just hunker down and they stop hiring people. It actually creates recessions. And so Reagan said, nope, I'm going to change the tax structure, because the highest tax bracket back then was 70%. So he lowered it down to 28%. He didn't think anybody in America should pay the federal government more than 28% in tax. Now, again, Many states has a tax on top of that of 7%. California at the time, I think, was 9%. Now they're up to, 13.5% or whatever. And so with the state tax on top of that, let's say 7 on top of that, many people shell out about a third, 33%, in tax if they make more than the average American does. Back then, it was married couples making over $45,000 or $50,000 a year. Now that's what Reagan did. He finally got that passed in 1986. It was called the Tax Reform Act of 1986. So what did he actually accomplish that year? In 1986, we defined in America the 3 types of income that Americans pay income tax on ever since. Earned income, that would be salaries and wages. Passive income, that would be like rent and lease income from equipment or apartments or whatever. And portfolio income, interest and dividends. So ever since 1986 tax reform, there are only 3 types of income Americans pay income tax on: earned, passive, and portfolio income. My favorite instrument for retirement income is not under one of those 3 definitions. So there is nowhere on a 1040 tax return to put it. It's not a tax loophole. It's not worth the IRS auditing because it has been grandfathered since 1986, and actually before that, to be tax-free, because it's not earned, passive, or portfolio income. It's what I call the laser fund, and I'll explain that here in just a moment. But before I explain it, if you can think of somebody that ought to be watching this episode, share, click like, subscribe to this 3-Dimensional Wealth channel, because I post an in-depth answer to a financial question almost on a daily basis. And I don't want you to miss out, and stay with me to the end. I want to gift you a very powerful piece that will help empower you with these strategies I'm explaining. So Reagan, back in 1986, he didn't want Americans to pay any more than 28% to the federal government. Again, 41 out of 50 states has a state income tax. So he studied in history, if you tax people more than a third, they will resent it. They will hunker down and say, what's the use of going out and even making more money or hiring more people or expanding my plant? And we had the most incredible decade after that. Now, Clinton came in and he tried to take credit for that, but the most prosperous decade of the 90s was actually set up by President Reagan because he lowered taxes. You lower taxes and it increases the revenue in the economy. Business was booming, and by raising the revenue that was being taxed, he actually raised more tax revenue by lowering taxes. Now, a lot of people go, no way. No, yes way. What's the next example? After the terrorist attacks of 2001, September 11th, Bush was in office, again, being of the Republican philosophy. Let's raise the revenue that's being taxed. Why raise taxes when the government was hard up for money, when people don't have the money to be taxed? You're hurting the economy. So he lowered taxes. He took the 28% bracket down to 25%. And guess what happened? People finally said, okay, I've got to take advantage of it. He lowered interest rates. And people began to go out and the economy picked up. And it was proven from 2001 to 2007 that actually the revenue that was being taxed went up dramatically. And the tax revenue was greater by lowering taxes than if they had raised taxes, because that would have hurt the economy. Does that make sense? So maybe the next example would be Trump. Trump in 2016, he lowered that 25% bracket down to 22% and introduced another one at 24%. And we had a booming economy clear up to and actually including the pandemic of COVID-19. That was set up by lowering taxes, which raised the revenue being generated in the economy that was being taxed at a lower rate. And so there's 2 philosophies. Now, I personally think it's better to raise the revenue that's being taxed and stimulate the economy and create jobs. Because when you raise taxes, it causes unemployment. Companies are forced to lay off people. We head into a recession, And then the government is caught in this dilemma. Well, golly, we're hurting. We can't lay off people. That's a bad example. And then they want to keep raising taxes. And so this is the big difference. And it's a dilemma that has gone on for decades. And you will hear politicians argue it back and forth. It really didn't raise the tax revenue. Well, how can you prove that really by going back and just raising the taxes? Because they'll say, well, we didn't have a recession. You would have had you raised taxes to the level that they wanted to. See, Hillary Clinton in 2016 wanted to raise the 25% bracket back up to 28 again. She wanted to lower the estate tax threshold because she had a lot of initiatives that she wanted to fund by raising taxes. So that's the dilemma. So what does this mean for you? You know, I love this great country of America. And way back when it began, we declared independence, okay? And I'm really concerned because I think we're creating a younger generation that is becoming more and more dependent. And if we go too far that direction, pretty soon a lot of the young people that I talk to, I say, what is your dream of America? What's the American dream? And I remember some of these young college students saying, well, to have the government pay for my college and pay for my first car and pay for my housing and pay for my health care and provide my retirement. I'm going, oh dear. If that is the American dream for young people, where are they getting this idea? Because that's going to require that taxes go through the roof, and who's going to be paying the taxes? And so I firmly believe that if you take ownership of your future, you provide for your own retirement, for your own good health, for your future, that you will take better care of things when you take ownership. It's like I've often said, when was the last time you washed a rental car or changed the oil on a rental car? People don't wash rental cars, they wash their own car. See, the secret to American wealth is in ownership, in deeds, titles, and articles of incorporation. And I explain this on some of my other episodes. But when you set aside money and you want to not have to be reliant on the government, you want to be independent, one of the best ways to do that under a sacred tax-free cash cow section of the code, it's under section 72E and 7702 and 101A. This is how you can accumulate, access, and transfer your money totally tax-free. It is what I call the Laser Fund. Laser is an acronym, LASER, that stands for Liquid Assets, Safely Earning Returns. The Laser Fund is where I recommend people have 40 to 60% of their retirement resources at retirement. At retirement planning is something totally different than maybe what you did for retirement planning. I have episodes on this very channel that show you how to, 5 years before retirement, begin to reposition money in your IRAs and 401ks. Get the taxes over and done with sooner than later and move it over to tax-free instruments, what I call the Laser Fund. And by doing that, I've helped couples take $200,000 a year of income and move $120,000 of it off their 1040 tax return. The IRS knows they're receiving it, but they know it's tax-free. If you want to learn how to diversify and create the foundation for a tax-free retirement, study this 300-page book. I want to gift this to you. It's actually 2 books in one. This white one, 200 pages, 14 chapters, all kinds of charts and graphs, all the detail. If you learn more by stories, you flip it over and read this one. 100 pages, 12 chapters with 62 actual client stories of how to use this for all kinds of financial goals, not just retirement. If you go to laserfund.com, click on the link below and contribute a nominal amount towards the shipping and handling, I'll cover the rest of that and I will pay for the book. I want to gift this to you. Check out some of the other educational ways that you can learn about this. You can listen and learn. You can watch and learn. There's an 18-hour masterclass where I do a very deep dive with my 2 sons who were co-authors with me on the book. And people who do that, they begin to take ownership of their brighter future. And you can move from a taxable situation, get the taxes over and done with, and enjoy tax-free income the rest of your life, and also make yourself immune from whatever tax rates go to, and inflation, and market volatility by moving money into the Laser Fund.